Thank you. It's a great question because you know, the CFTC, I often say, is the most important financial regulator that most Americans have never heard of.
I agree. I agree entirely. I think that's right.
Now, obviously, people in this room know it, but I mean, the CFTC, as I say, sort of, it regulates everything from corn to crypto. So it's essentially the Americans' derivatives regulator. But as a result, it means that if we're going to be a good regulator, we need to understand the underlying markets. So it started off many, many years ago, first at the Department of Agriculture, and then in the 1970s we became an independent agency, but it was primarily focused on agriculture. So we have, and that is still a core part. In fact, I would argue it's even a cornerstone of what we do. Then energy came along, then financial products came along, and now we've got digital assets. And so in order to sort of consider the futures markets, swaps, and other derivative instruments that are trading on these, we find ourselves in a situation where we really have to understand it. We have to understand Silicon Valley, blockchain, crypto assets, etc. So I dealt a little bit with this at Treasury, but now we're a frontline regulator.
So we're already starting off by saying corn is not the same as Bitcoin, which is, I think, an important something to observe. But on a more serious matter, this has been, the last week or two have been very, very interesting and exciting from the cryptocurrency world. Earlier today we had a conversation with lots of central bankers about announcements coming out of the G7, but you've been also making some very interesting conversations or observations, one of which caught a lot of headlines, had to do with Ethereum, in which you had observed that in your opinion, it's not that it is a commodity. Maybe you could just sort of elaborate briefly on that observation, and we'll just take it from there.
Sure. So the way it works is, and I know one of the issues that the regulatory community, when these statutes were written, so the Commodity Exchange Act dates back from 1936, the Securities Act, 1933, no one in their wildest imagination would necessarily think about digital assets. In fact, there was no digital anything, right? We were lucky if we had analog back then. So we find ourselves taking this new technology and trying to put it in a pre-existing regulatory framework. Now the good thing is that many of our statutes are pretty flexible, and so we can import those into our regulatory framework. But the way our jurisdiction in the SEC works is essentially if it's not a security, it's most likely a commodity. Our definition of a commodity is really broad. It's so broad, in fact, that Congress had to specify that movie tickets are not a commodity. So if movie tickets are not a commodity, pretty much it falls in. And so where we're seeing it is if the Securities and Exchange Commission has undertaken its analysis and comes to the conclusion that the particular crypto asset doesn't meet the old Howey test as to whether it's an investment contract and therefore security, in most cases, it's going to fall in. And so Bitcoin, last couple of years, we've definitely treated that as a commodity. And now I was happy to make the announcement with regard to Ether.
Last year we had Bill Hinman here, and it was shortly after some very important observations about really, one of the novel aspects of digital assets, and the fact that it can kind of start off as one thing and then it ultimately evolve into something else. When you think about Ethereum, is that more of an observation of sort of what's on your plate now, or is that an observation about sort of its origins? I mean, when you look at it, Ethereum, you're taking it for what it is, or is this a longer term observation as to its legal status?
I think right now we're taking it for what it is because that's what we can do. And I think you're exactly right that digital assets, depending upon the changes, forks and things of that nature, we could find ourselves, now all things being equal, I think many things that, let's say, start off as a security, to the extent you no longer have the active role of the company that started it and the management, and therefore you're dependent upon, quote unquote, the efforts of others to realize the value, and it starts to migrate to something that's more an intrinsic store of value, it would likely migrate from a security to a commodity, but doesn't mean it can't go back the other way.
Well, first of all, I just want to thank you for validating to my law school students who are in this room that there's a purpose for teaching the Howey test. And then secondly, just sort of dig in, deeper, because it's just conceptually, here we're at a university and we have lots of thought leaders who are trying to think through this. It's just the idea that you can have a financial product that evolves over time one way or the other. From your seat as a regulator, that's got to pose a number of interesting questions, even from the kind of oversight world. Yes. It's certainly interesting for the market participants, right? Because they have to figure out, okay, I'm issuing something, what is it? I'm creating certain kinds of applications or new infrastructure. Is it still what I think it is? But there's also, from your standpoint as a kind of a market supervisor, making the call to keep track of those kinds of developments. Maybe, how are regulators positioned, or what kinds of conversations are you having about not just making that T1 decision as to, okay, this is what it is right now. I mean, how do you think regulators can keep abreast of those kinds of changes so that they can provide either real-time input to the market as well as just to one another across agencies about these instruments?
Yes, so it is so important, because although, yes, things can change over time, if the market needs anything, it needs certainty. And our regimes were set up to do very different things. So the securities, the hallmark of the securities framework is investor protection and capital formation, and then obviously orderly markets, but those first two are critical. Our markets are very different. We focus more on commodities that have some kind of extrinsic value, and the derivatives markets are there to allow risk hedging based on those commodities. And then obviously speculation helps engender that market and keep it vibrant. So if something really has investor protection issues, and it's not sort of ultimately going to be potential commodity for risk mitigation and other things, then it does matter, because different regimes are set up to achieve different purposes. So clarity and consistency and certainty is really important. We have started a dialogue, to your question about how do regulators work together on this. And so there is a crypto assets working group. I think it's chaired by the Treasury Department, and all of our regulators regularly talk about that. The other thing we have internally is Lab CFTC. And I'm happy to have Melissa Netram with us today, who's our new Lab CFTC director. And Lab CFTC is sort of our internal think tank that keeps track of all of these developments so we can inform the agency. Again, many people in our agency are experts in cattle. They're experts in corn. They're not necessarily experts in crypto, but now we have these contracts trading alongside one another in many cases, and we need to make sure that we're appropriately educated.
Getting back to the Ethereum question, and because you're making a great observation that ultimately, okay, we're not talking about cattle and corn, we're talking about crypto. Crypto projects can evolve, cryptocurrencies can evolve, and the heterogeneity within the cryptocurrency world is vast. One of the interesting points is that Ethereum, just sort of comparing like a Bitcoin as a kind of a payment system, and then Ethereum, which has greater aspirations, for programmability of contracts and interoperability and the like. When the CFTC, because I imagine there are going to be a lot of projects that'll come under your authority in the next several years, how does the process of sort of evaluating from a regulatory standpoint the different potential risks that could inhere with any particular crypto project, like how do you guys go about thinking about it? Because again, Bitcoin, if you want to create a Bitcoin futures, that has its own set of risks. Ethereum has different sort of use cases and purposes. What's the way in which the agency sort of goes about evaluating that before that product comes to market?
So when we think about a futures product based on that, we have a couple of different regimes that we have applied and that have evolved over time, and arguably they've evolved over 150 years. Core principles, number one, for contract markets: how do you make sure that a futures market is vibrant, has integrity, and also has the stability and the transparency that it needs. And then also, if those are going to be cleared, we have derivatives clearing regulations. We have core principles for them as well. So we actually start with our regulatory regime and say, what are the criteria that this particular contract needs to meet? And then let's then look at the characteristics of the particular digital asset to understand it. When I think about our contract markets, for example, so that's the exchange, one of the key features that every exchange has to do, either through self-certification or we decided as an agency, is determining whether or not the contract is subject to manipulation. So if the contract, it can be manipulated, its price can be manipulated, then that's a no-go, and we're not able to list that. So we would do that. On the core principles side for clearing, we would look at sort of the financial risk factors with this product. Is this, what's the level of volatility here? How can we set margin requirements, for example? What we've done in the past few years is just have them fully collateralized, so we aren't focused on margin as much as with a regular derivatives contract that has a great deal of leverage. But how do we set the proper margin so the risk levels are there? And then again, we would look at the specific contract to determine, or the specific digital asset to determine how it meets those features.
This is so interesting. It is, as a law professor, you just want to really nerd out on all of this. So I will try to contain myself as much as I can. But so right now, there's been a lot of interest. Obviously, Libra has sparked a lot of interest in stablecoins. We have people in the audience from central banks who are trying to grapple with those same questions or similar kinds of questions. When a stablecoin, bringing it back to the Howey test, if it is truly stable, there's a priori a kind of strong presumption that it's going to be a commodity, or at least not a security, just because it may not necessarily satisfy the profits prong, unless you get into other kinds of technical kinds of questions about whether or not you have ETFs. But just to keep things really simple for the moment, that would seem to suggest that there are potentially, if stablecoins become more popular, a potentially large number of different financial products that even come, that again will find themselves under the CFTC's jurisdiction with regards to derivatives contracts being written in that reference those stable coins. And then you have the question as to the manipulation. The CFTC enjoys anti-fraud authority for those spot markets. Just really basic question. That's a lot of new work. The resources for that would have to be somewhat considerable. Do you feel comfortable, given again the interest in this space and the fact that you're going to have likely a ton of new instruments? Do you feel that you have the capacity to do your job and to evaluate all of those different stable coins and cryptocurrencies that are coming your way?
Yeah, so I would say we are working to build that capacity. We have, and so this is for all of you that are interested in a potential government job. CFTC is hiring, I'm happy to say. But one of the things we look for when we think about bringing people in to at all levels of the organization is thinking about not only what the markets are doing today, but what they could be doing a few years from now. So I've tried to bring in people with a number of the people that I've hired recently have experience with digital assets, or from Silicon Valley companies, for example, because I think that's really important. Just as when we hire people to monitor the energy sector, that they actually have some real world experience and understanding. So it's so important to make sure that we keep up. So I would say it's a continual process of making sure that we've got the right capabilities.
One of the interesting sort of challenges that I've seen, for example, when I teach a class, if I ask my class, and I'll have 100 students, securities regulation, I'll ask them, well, how many of you own stocks, right? And maybe Facebook or Amazon or whatever. And out of a class of 100, maybe 10 kids will raise their hand, and then I'll ask, well, how many of you have owned Bitcoin? And then you'll have like 40% of the class raising their hand, and that's a fascinating sort of generational change. Does the fact that when you look at those markets, these professional markets, that lay at the origins of the CFTC, the agricultural market. And now you have this new product where you're going to have more retail investors, certainly in the spot market, and potentially, if those futures products provide more liquidity, you can see folks trying to get involved, at least in derivatives markets. How does that change sort of the mindset of a regulator that has traditionally made certain kinds of assumptions about the nature of the market participants? And
it's a great question. So right now, some of our exchanges that are trading these futures contracts or swaps in some cases are still limited to eligible contract participants. So it still very much is not the retail investors, but there's obviously going to be interest from the retail. So you mentioned this a few moments ago, and it's an important distinction to make, is that the CFTC regulates only the derivatives markets. We do not regulate the so-called cash market. We don't regulate the spot market for these transactions. So there are a number of exchanges throughout the country that are certainly not regulated at a federal level. They may not even be regulated at a state level. That said, we do have a few that are designated contract markets regulated by us that are trading the futures contracts, and in some cases swaps, but the futures contracts is the main thing. And if there's manipulation in those unregulated exchanges, they will inevitably affect our futures markets. So we have fraud and manipulation authority so we can't regulate the spot market, but we can bring enforcement actions against the spot market. So to some extent, we are involved there, but that also takes resources. I think one of the issues that this country is facing is that we don't have a uniform type of federal regulation for these instruments, and that's a question ultimately for Congress
At one point, and I can't recall the exact nature immediately as to the request, but your predecessor had requested, I don't want to mischaracterize it, but I believe that he had requested more authority in terms of the CFTC's ability to police cryptocurrency markets. Would your job be easier with certain forms of more explicit authority, even when it comes to executing the job of overseeing the derivatives markets?
I mean, my view would be I would much prefer an evolution as opposed to a revolution, where overnight the CFTC is transformed into something that we've never been. That said, I mean, one possibility would be, for example, if you had anything, so right now we have designated contract markets that trade the futures contracts, as well as swap execution facilities. These are registered with us. We regulate the products on there that constitute derivatives under our rules. But if they wanted to trade a cash product, we actually don't have regulation over that. So that might be an important first step, as opposed to us regulating everything in the world, everything in the country, dealing with crypto assets. And again, many of these things are not commodities at all, they're securities. But if they were a commodity and they were traded alongside the futures contracts on the same CFTC regulated exchange, then that might be an initial first step where people that wanted to bring these products on board would get the benefit of a uniform federal regime and not have to worry about the patchwork of 50 states. But I would much rather have it be an evolution and have the decision up to the private sector than to have a uniform rule sort of applied immediately overnight.
So picking up on the sort of the incremental phase, I think that certainly from what I've heard from folks in the market, when you were able to sort of make that observation about Ethereum, a lot of folks, I'm sure, were both relieved and also it provided a certain degree of just transparency and a sense of, okay, now we know where we are, at least for this. There are lots of cryptocurrencies out there, and you have attempts by market participants, including exchanges, to create ratings agencies for different kinds of products, as to, a little bit warm, maybe a security, hot, it probably is. But that's still a market-led sort of intervention, and sometimes those bets by market participants can be wrong or even conflicted. At this point in time, how is it, do you think, that the regulatory agencies Do you think that maybe the regulatory agencies, including the CFTC, will increasingly rely on just affirmative observations and frameworks to sort of incrementally provide more detail as to where a particular crypto asset lies? Or do you think that other kinds of either regulatory or market initiatives are in the work that you find to be positive to help to provide the market participants with more clarity? Because it's fantastic, I think, that we have more clarity on Bitcoin and on Ethereum, but there are several thousand others, I think, where people would like to know a little bit more. Do you have any thoughts about how more clarity can be introduced?
Well, I think it's going to be difficult because ultimately it is going to be the regulator that makes the final say on what's a security or not a security. So everybody out there, you should consult with your attorney, I should say this, before deciding something is or something isn't something else.
Georgetown graduate.
Exactly. But that said, I think we are trying to do our best as regulators to consider applications, consider new products as they come to us. So one of the roles that Lab CFTC plays, and one of the roles that it will continue to play, and even more so under Melissa, is to be that link between Silicon Valley and Washington, to teach individuals about our regulatory framework and how their particular asset may come in. Now that also requires substantial coordination with the SEC, for example, so they can decide whether or not it's a security or not. And if it's not, then as I said, it most likely would fall into a commodity. It also requires coordination with other regulators. And so you saw that the G7 report recently on stable coins. There are a number of issues that are coming out.
With that, again, your statement on Ethereum caught a lot of people's attention. Do you think that there will be any time soon? Well, first of all, with regards to Ethereum, if you're going to handicap the release of any kind of or the coming to market of an Ethereum futures contract, do you think this is something that is likely in the next 6 months, year?
Yeah, I'd say it is likely that you would see a futures contract in the next 6 months or year. Absolutely. The volume to which it'll trade, no idea. That's for the market to decide. But my guess is now that we've provided, or at least I've provided a little bit more clarity on that point. My guess is market participants will consider that and self-certify or otherwise bring to us a potential contract. So I think it's likely. Again, I can't say the volume of the trading, and right now, even across crypto assets, the volume compared to our more mature markets, financial contract, energy is still quite low. But that doesn't mean all of those contracts started one day very small as well.
It strikes me that in a very interesting way, if you can certainly have a futures contract traded, it could be viewed as a sort of a gold star, if one will. I think traditionally you may look at it from a market perspective, that there may be enough people interested in the underlying asset that there's a market for a derivative in the first place. But I think that given the regulatory both uncertainty and the unusual characteristics, some people may like it just because it involves as well the introduction of that crypto asset into some kind of regulatory framework. Is this something that sort of crossed your mind, that you're not only providing that certainty, but you are sort of introducing that crypto asset into a regulatory environment, and if it passes muster, then maybe there's, for lack of a better word, a halfway point between the market and the regulators where everyone's viewing a mutual gain?
Well, I think what it does is if you bring a digital asset into our markets and it's classified as an underlying commodity and therefore you can have a derivative on it, our markets don't guarantee value, obviously. So it doesn't necessarily say this is worth a lot or this is worth a little. That's for the market to decide. But what our markets do, and been doing it for 150 years, is ensure that there's sufficient price transparency. So when you look at the screen and it's on a CFTC regulated exchange, that you know that there's the buyers and the sellers, and that price actually represents real aggregate demand. It's hopefully free from manipulation, which is what our system has been set up to do. And that also too, it'll be delivered. So if it's a delivery contract, it'll be delivered. If it's a cash contract, cash settled agreement, it will be settled because you're doing it through a regulated exchange and a regulated clearinghouse. So I would say it's not about the intrinsic value of the asset, but more about the process. That at least if you enter one of our markets, there will be that bedrock there of long-standing, dependability.
Would you suspect that there may be other and beyond Ethereum? I mean, if Libra is a true stable coin, I guess you'll have lots of fun there. But is there a...
We don't know. I mean, the answer is that one where everyone is still looking over and thinking about, how does it actually function?
I totally hear you. Is there a sense that beyond Ethereum that there will be other derivatives coming soon to a market near you for crypto assets?
I'm not sure if I can say coming soon, but given there's a couple of thousand out there, as the SEC sort of works through its process, as we work through ours and other regulators, it's likely we'll see more. But I can't tell this audience that it's necessarily coming soon, because even the two that we thought about, Bitcoin and Ether, it took us quite some time to work through those.
Interesting. Okay, so okay. Hands up before I even say questions.
And by the way, just to be clear, I am sitting in front of an audience of experts, as you as well. So in many ways, I'm here more to listen and learn than I am actually to teach you guys. So you don't necessarily have to have a question. You can give me a comment. If there's something you think the CFTC should be doing, should be thinking about, I'm very much open. I've just